All right there, econ friends, welcome back to another series of videos. In this series, we're going to be jumping into the market structure known as monopolistic competition. Okay, if you recall, we were looking at market structures through the lens of a spectrum or a continuum, and we had identified perfect competition as one extreme and monopoly as another extreme. And again, these structures defined in part by the number of firms, the degree of pricing power, the barriers to entry, the amount of sustainability in terms of can profits sustain in the long run. These different criteria, they identified a market structure. We had started off with perfect competition and then monopoly so that we can take the two far extremes. Now we're going to build in the middle. And today's topic will be monopolistic competition, MC. As always, when we go through this, we're going to be first starting off with context, definition, assumptions, and characteristics. Then we'll be jumping into the profit and loss decisions. How do firms decide their big questions? How much to make, what price to charge, and are there profits? And then after that, we'll look at the comparison between, in this case, monopolistic competition and perfect competition, because we're always trying to get comparisons and see how does this particular structure stack up in terms of economic efficiency and overall social welfare. And then we're going to wrap up this section with a quick discussion of advertising, because we're going to find that especially in monopolistic competition, we see the presence of pretty intense advertising. So we'll take a really quick look at what advertising is and sort of the economics of it and why firms in this structure do it. All right, so let's jump in and let's begin as always with some definitions, some assumptions, some characteristics. So what is monopolistic competition? Well, monopolistic competition is a market structure. And in this market structure, you have many firms selling similar but differentiated products. This is critical, okay? Monopolistic competition is a market structure, so you have many firms. It's really important. But what these firms are selling are products that are differentiated. They're similar, but they're different. And one of the key things that marks the monopolistic competition structure is that they're not selling identical goods. They're selling products that have some differences. And one of the big goals of a firm in this industry is to try to highlight those differences and get you to be loyal to that product and not a competitor or a rival or a substitute product, okay? So to wrap it up, monopolistic competition, market structure, many firms selling similar but differentiated products, and critically, in a market with low barriers to entry. Okay, so those are our big pieces of this model. Just so you know, different economists will use different terms for this. This market is also known as a competitive price searcher market. It's price searcher because firms in this industry have a little bit of market power brought on by those product differentiation factors. But it's also competitive because, again, there's many, many firms, okay? So monopolistic competition, AKA a competitive price searcher market. The real big thing you have to take away from this model is that firms that compete in the monopolistic competition arena, they sell products that are similar, but that are somehow differentiated. And as a result of that, firms in this industry will engage heavily in what we call non-price competition. What do these two things mean? Well, product differentiation, this refers to the real or perceived difference among products that are close substitutes. Take a look at hamburgers, take a look at types of pants or shoes. These products are similar, but they're somewhat different. Critically, while most of the time differences are real, sometimes the differences are strictly perceived. And a lot of times in those cases, you'll see firms in this industry really try to engage in advertising that is persuasive to get you to attach some sort of emotional connection to a product, because really there's no difference, real difference between their product and a rival product. So they try to create this perceived difference. But at the end of the day, the big takeaway here is that monopolistic competitive firms, they strive for product differentiation. In a crowded competitive arena, they try to make their product somewhat different to make it more appealing to you. Because the idea is, if they can make the product more appealing to you, you're going to be a little bit loyal to it. And that's the key. That loyalty gives these firms not total, but at least a minor degree of pricing power. And this is critical. Okay, so product differentiation ultimately leads these firms to have some pricing power. The other thing to point out is this idea of non-price competition. You can consider product differentiation to be one of multiple forms of non-price competition. And non-price competition is a real broad term in economics and business strategy that just basically refers to the different tactics or strategies that businesses take in order to distinguish their products from substitute products without changing the price. Okay, and there's lots of ways that companies do this. You take a look in the products that you buy, take a look at the ads that you watch. You will find companies doing lots and lots of things to try to make their products seem a little bit different outside of changing price. What are some of the things that they'll do? Well, some common tactics that companies use to differentiate their products or to engage in non-price competition. The most common one is that they will actually have differences in the physical product design. Hamburgers will have different ingredients. Clothes like pants or shoes will have different styles or different quality materials or different aesthetics. You get the idea. You can also sometimes see differences in product quality. Some products are designed to be lower cost to appeal to a more price-sensitive consumer, and they may have lower quality. Lower cost would often imply lower cost of production, which would imply different materials, different production techniques. On the other hand, some companies will charge premium prices, but they'll back that up by stressing really, really intense product quality, or increasingly this sense of like artisanship, where things are handcrafted. Notice again that this is just one way that a firm can make its product different than other rival products. So you can have differences in the physical product design, differences in product quality. Oftentimes, firms will engage in non-price competition by selecting different locations in order to appeal to consumers. They may stress and differentiate in terms of service and convenience, where some firms or companies go all out and really sell service, sell convenience, and others don't. You can also have a form of non-price competition and differentiation through these kind of abstract and very emotional aspects of prestige and perception. You know, you take a look at some lines of clothing, some lines of designer accessories, purses, handbags, belts, things like that. You take a look at some cars, and there's a real big premium placed on prestige, right? On performance, on perception. Sometimes these are real, sometimes they're perceived. But if a company can stress and convince a prospective buyer that their product conveys prestige, that it's perceived as elite, they're going to probably get customer loyalty, which, as we know, will translate to pricing power. The other way, and this last one kind of wraps up all the other ones, but a really common way, and for those of you guys who are marketing majors, something that you'll be doing in your future careers, another way that firms engage in non-price competition is through spending significant resources on advertising and specifically on brand building. Branding being basically this really kind of weird, abstract, and very emotional connection that people will have toward a brand or toward a company or toward a logo. And it's weird when you think about it, yet we all do it. You can probably take a look at brands that you're loyal to, brands that evoke certain feelings in you, that make you want to be a part of it, that make you want to buy it. If a firm can do that, it's really won this non-price competition game, okay? Let's move on. We had these different assumptions in the model. The product differentiation assumption that we talked about, this implies that firms in the monopolistically competitive market, okay, I'm going to call it MC, monopolistically competitive, MC. The product differentiation assumption implies that MC firms will face a downward sloping but highly elastic demand curve, okay? So, we have P and we have Q, 0 there. The monopolistically competitive firm will have a downward sloping but highly elastic demand curve. It's going to be downward sloping because of the market power that they get from the advertising and the loyalty and the product differences. But it's going to be highly elastic because even though it's different, there's a lot of rivals out there and consumers have a lot of options. And from before, from our thrilling lecture on elasticity, that more options, more substitutes means a product is more elastic, okay? So the product differentiation assumption, had to slow down there. This implies that the demand curve for the MC will be downward sloping, but highly elastic. The other big assumption is the low barrier to entry assumption. And this is going to have several really important implications for firms in the MC structure. Implication number one is that these firms are going to face some pretty intense competition. There's the potential to get product loyalty, to earn profits, and that's going to make firms in this market compete really intensely to try to gain and hold market share. Another implication is that there might be some profits, and as we learned before, because of, again, low barriers to entry, these profits will draw in rival firms. In other words, in this structure, we're going to see short-run profits that are going to incentivize entry. And this entry, as you know, is going to have some implications on the long-term dynamics and on long-term profits in this structure. And the other big implication tied to the low barrier to entry assumption is that, as you can predict, in the long run, firms in this industry will earn only a normal profit, aka they will earn zero economic profit, aka they will end up producing at a level where price equals average total cost. It's only when we reach that condition and there's no more profits that there's no more incentive for entry or exit and we reach long-run equilibrium, okay? One concept that I want to raise with you that's tied to this idea of low barriers to entry is an economic theory known as the contestable market theory. A contestable market, this is an economic term. A contestable market is a market in which firms can enter and exit with minimal risk. In other words, a contestable market is defined as a type of market, or how about this, a market that exhibits conditions such that new firms can enter and exit with minimal risk. What does this mean? Well, it basically means that there's going to probably be a lot of actual competition and potential competition because a new business would risk very little by entering the industry. You might say, well, what if there's a high startup cost, a lot of fixed cost? Well, if the market is contestable, that's not a real major issue because in a contestable market, even if you required significant startup capital to really do a lot of upfront investment and get your fixed costs controlled, it would not be a major deterrent because in a contestable market, if the firm was going to exit, it could probably sell off a lot of those fixed assets and somehow recover its costs. Okay. So a contestable market, again, has a unique set of characteristics that really minimize the risk for entry. The big thing to take away is that in a contestable market, there's going to be a lot of actual competition, but there's also going to be a lot of potential competition. The idea that any rival firm could enter at any time really puts pressure on existing firms. And in effect, both the actual competition and the threat of potential competition, those are going to serve as mechanisms, as incentives that are going to instill a lot of discipline on existing sellers. You can imagine that for these reasons, a lot of economists are very supportive of policies that lower barriers to entry, that reduce the risk of entry, that make markets contestable, and that ultimately ensure market competition. Okay, so that's what a monopolistically competitive market is. Different products, easy barriers, easy entry and exit, low barriers, what we would call a contestable market. And one more thing to bear in mind, this final characteristic here, firms in monopolistic competition will also engage in price discrimination if they can, in order to increase their profits. We had learned before that price discrimination was the practice of selling the same product to different customers at different prices based on segmenting those customers and trying to figure out the different elasticities. Increasingly, we see that in monopolistic competition markets, especially when these MC firms have access to lots and lots of customer data, that it makes it much easier to segment the market to determine elasticities. So this is not a formal condition of the MC market, but an increasingly visible characteristic is that firms in monopolistic competition will engage in price discrimination, charging different customers different prices for the same product in order to increase profits. Okay, so there you go, my friends. A quick overview of the definition, the traits and characteristics and assumptions that make a market structure monopolistically competitive. In our next video, we'll take our next step and figure out the big decisions, right? How much to produce, what price to charge, and do we have profits or losses? We'll go back to our tried and true step-by-step method, and you'll be solving these problems in no time. Thanks for tuning in, and I'll see you next time.